Welcome to Remarkable Retail Podcast, Season 7. I'm Michael LeBlanc.
And I'm Steve Dennis.
We have another one of our very popular Encore episodes, this one from late 2021, but really could not be more timely to reprise towards the end of 2023, the profitless prosperity of Disruptor brands.
It's interesting. I didn't really know this until we started going back to look at episodes for possible encores, but right about the time that we first broadcast this, many of these disruptor brands, so this is everybody from the digitally native vertical brands, the Allbirds, Warby Parkers, Rent-the-Runways, to some of the companies that were basically online only types, Wayfair, et cetera.
Yep.
Most of these brands, at least the publicly traded ones, hit their peak valuations right about the time we did this episode. So I think part of our motivation for doing it in the first place was like, this seems pretty crazy, these valuations, particularly given the amount of money that many of them are losing. Since then, we've seen a deterioration in the performance of many, but some notable exceptions, which I'll get to in just a minute. But I also want to just briefly mention, we've talked a few times in recent episodes that we're not going to do a formal recap or like mid-year review that we've done in the past couple of years of my 2023 predictions. But I did have a specific prediction around the disruptors, which I called this idea that there would be a disruptor reset.
Yeah.
And even though 2022 is a pretty rough year, I believe we'd see further challenges here, both in terms of the financial performance, but also things like bankruptcies, management changes, rethinking of strategies, and that's really started to play out. So in terms of financial performance, we have seen many of them lessen their losses. But for the most part, the ones that we talk about in the episode, as well as some we've touched on since then, continue to see pretty significant losses. And as I mentioned, we saw kind of peak valuations from many of these companies. So just a couple quick examples. Allbirds was $24 at the time this episode came out. It's now $1.33. Stitch Fix. Oh, yes. We have to do the wobbly unicorn.
Wobbly unicorn.
Very wobbly. Yeah, actually, most of these companies were all billion-dollar-plus valuations.
Yeah. I think it's important for the audience or for us to talk about the fact that, when you look at a stock valuation, that's one metric, but it has pretty important implications for these startup organizations who are trying to say, come work for me because you'll make money on the growth in the stock plan, right? So I'll pay you a bit less and you'll make it on the upside. So when you drop from 24 to $1.33, it has very important implications for the people who work there and their ability to hire people, right?
Yeah, and you can really, I'm glad you brought that up because one of the things, and I know we've mentioned this a couple of times, but when you look at the GAAP, not to get into too much accounting, but when you look at the GAAP net income, and then they do this thing to go to what they call adjusted EBITDA, in many cases, the big number they're backing out is the stock-based compensation. And you're absolutely right. That's a big number for most of these companies every quarter. And to the extent that the stock doesn't look like it's going to go up, yes, that's very significant. Also, in terms of borrowing money, in terms of if they need to raise additional venture capital, whatever it might be, these valuations are pretty important. So it's much easier for us to get visibility to that with the publicly traded companies. But of course, there's a lot of pretty sizable disruptors like Untuckit and Madison Reed and others that are not public. But so just a couple more quick examples. Stitch Fix, $28 to under $4. The Real $13 to about $2.50. Rent-the-Runway, $15 to under $1.50. ThreadUp in the resale business, $20 to under $4. And Wayfair, one of my favorite companies to complain about, they have had a bit of a resurgence in the last year, but relative to November 2021, they're down about 70%. And Warby Parker, which is really one of the ones that is still a unicorn and is shown more, and shown more progress, they're still down quite a lot. And then just really quickly, we've seen some bankruptcies. Boxed is one that happened more recently. We've seen some consolidations as predicted. Dormy getting purchased by Victoria's Secret. Walmart has sold off Bonobos and a couple of the other acquisitions they made. We've
Casper,
seen management.
Casper. Whatever happened to Casper?
Yeah. So quite a few. And then one of the other things were management changes. So we've seen Matt Baer, who's the chief digital officer at Macy's, recently joined as the CEO of Stitch Fix. And then John Corral, who's been around previously at Neiman Marcus and Canadian Tire and a few other places, is now the CEO at The Real. So kind of the adults are in the room at a couple of these companies. So it's definitely been a challenging environment. So a lot of what we talk about in the episode continue to be concerns, and some of the predictions essentially we made have largely played out. So we could have called this the "I told you so" episode, but we decided
we're not like that.
That's a little bit tacky. But I will say, in terms of some balance, is there are some success stories. They're just in the minority. So these aren't the only ones, but On Running, which is done a little bit more of a traditional kind of strategy with leading more with wholesale, but also having their own stores, continues to perform really well. They just reported their quarterly earnings with great growth, great profitability. Hims, the sexual wellness brand, is now getting into other categories. Sometimes, I joke that with Hims, there's nowhere to go but up, particularly if you use some of their products. But they continue to show great growth. Like 85% gross margin or something.
By the way, there's a late snare trap for you.
Sorry, I should have, we should have blocked that out in rehearsal. And then a brand like Yeti, which again is a little bit more, doesn't usually get thrown into the digitally native vertical brands per se. I think because they started like On did, with a little bit more of a wholesale strategy, complemented by online and stores. And then Viore, we recently reprised the Joe Kudla episode. So there definitely are folks that started around the same time and had a fair amount of funding, much like the brands we mentioned that are struggling, that have found a way to make money and be on a really good trajectory. So that's probably more than enough updating before we get into the heart of the episode.
It's a fantastic discussion, though, because I think it's so relevant. And we've done some content on it before, and I'm sure we'll be doing content on it again. So it kind of like not even just a midpoint, but it's a fascinating element to watch. So without further ado, and there has been much ado, let's get to our encore episode right now: the Profitless Prosperity of Disruptor Brands. Let's take it from the top. What in your mind, this disruption word came out, you're a disruptor, it used to be unicorn, used to be whatever. What in your mind makes a disruptor, and who are these disruptors? Who are these disruptors that you speak of? Tell me a little bit more how you're thinking about this.
Well, some people may be familiar with kind of this idea of, the legacy brand and then the insurgent brand, some brand that takes on I guess it's the David and Goliath, I guess would be the other cliche, by finding some sort of vulnerability in the big guys model. So they reinvent, maybe they go after a particular weakness, some point of friction, or a
little more nimble,
Yeah. So there's a lot of different ways that can play out. The way it's played out in retail, I think number one has been leveraging, obviously, the power of the internet. To go direct to consumer. So in some cases, you've got the DNVBs, the digitally native vertical brands, which started as online only, and we'll talk about the evolution on that in a second. But tended to go after a particular product. So Quip in toothbrushes, Warby Parker in eyeglasses, Untuckit in menswear, and so forth. So they take a particular category. They go after some sort of product innovation. But the original premise was by going direct to the consumer, they can cut out a lot of the asset-intensive aspects of retail, physical stores, all this inventory, and have that direct relationship with the consumer, not be reliant on a middleman. There's other direct-to-consumer models.
And they tend to be very vertical, right? I mean, if you think of Untuckit, for example.
Yes.
They basically have one value proposition. We sell shirts that look good untucked. I have a few. Right. Very, living up to their name. We sell this. We don't go this way, right?
Yeah. Category or product focus and in the technicality of the DNVBs, they're vertically integrated. In other words, they're their own brand and they design and control the manufacturing. Now you have other players that you could say are disruptors in the retail space. Amazon, obviously,
right?
But Amazon, is not a digitally native vertical brand. They don't own and manufacture. They're a multi-brand retailer, as is Wayfair. There are others, right?
Yeah.
So, and then, there are other kind of disruptive consumer brands, I guess, from Uber, Airbnb, but more, I guess, in the center of retail would be, for example, the resale players, Poshmark, ThredUp, those guys that are in the sharing economy, bringing supply and demand together, Rent-the-Runway. So there's a slew of them, and these brands have attracted a tremendous amount of venture capital, and so they are disrupting the kind of normal or traditional structure of the retail industry by going to market in a different way and perhaps poking at a vulnerability or two of the legacy players.
They also, and this came out, I remember I was sitting with a bunch of traditional mattress retailers, and they were a little frustrated by they kind of had a sense for how big the business was, and they were frustrated that mattress, in this case, but other brands, were sucking up all the oxygen of attention, if not sales.
Right.
Like, how much, they were like, they're a bit of the mosquito in the tent, for sure. It's not fun when you're camping and have that mosquito in the tent. But they're like, it's really, we can't get a word in edgewise because all everybody wants to talk about is, these brands. So that was, I felt that was problematic for a whole bunch of reasons, from an attention perspective and a media perspective.
I think there are a bunch of things there. I have a client that refers to some of these brands as mosquito brands. They're small and annoying and you want to swat them away. Yeah. But I do think, there's a lot of things going on. From a media perspective, they're fun to write about, usually, right? Because they've got something new and cool, maybe have a really charismatic founder or whatever. The venture capitalists are trying to hype it. Yeah. So there's a lot of energy behind promoting the story and trying to get that next round of financing and get that consumer attention. But I think the thing that is disruptive to the whole cycle has been that many of these brands, of course, not only, and Casper's a good example, or Warby Parker, they have a strong value equation. We are 10, 15, 20% less expensive than the competition. And they're also putting a tremendous amount of marketing out into the industry to try to create their brands, but drive that business, very aggressive with discounting. So the combination of the lower prices and all this marketing puts a tremendous amount of pressure on the existing players. And I've talked to clients I've worked with and others about, what do we do when we have this company coming in that is sucking up a lot of the attention, that's putting a lot of marketing out there, that's pricing at uneconomic prices and starting to steal share from us? Do we try to swat them away like that mosquito, or do we say, these guys aren't for real, and we'll stick it out? But if you're in the home furnishings business and you watch Wayfair go from nothing to whatever they are now, 10, 15, $20 billion, they're a big player. Some of these other players, as we'll probably talk about a little bit, they're definitely punching above their weight. They're not necessarily huge businesses, at least yet.
Yeah, it's interesting because on the ground, some of these businesses, because they all inevitably, interestingly, turn their minds to physical retail. We'll get to that a little later. But they pay top dollar in the malls. They come in, they have the top dollars behind them for marketing. Yeah. They see it as a marketing tactic as much as anything. They go in the premium places. And as you've been saying, as we see these IPOs come out, as we get more information, we start to get both the size of the business and the profitless. And this is why this episode is Profitless Prosperity, because they're growing, but they're coming back down to earth a little bit for some of them because the basic unit economics still matters, right?
Well, we'll see. There has been a lot of speculation, and I'm guilty of a lot of it, that many of these brands that were private were spending crazy amounts of money on marketing and building out all their infrastructure. In many cases, might not be pricing at a sustainable rate to grow market share. And so they're like this rocket ship in terms of sales. But what else is going on in the market? So as we start to see, and we've got, I think, 12 or 15, something like that, of these pretty significant DNVBs that are now public. Well, now we're getting to see what the picture looks like. Yeah. And at least in terms of current profitability, most of them are continuing to lose a lot of money. Of course, the question is, because, Amazon lost money. Lots of companies Tesla loses money. There's plenty of companies that look to be enduring brands that have lost money for an extended period of time. So it's hard to really tease out how much of this is kind of the normal growth curve that will allow them to be these powerful brands versus basically, kind of the emperor has no clothes, that there's just a lot of hype around these. So I think it's hard to tease out. We had Dan McCarthy back with us a few episodes ago to look at some of the unit economics. And I think some of that kind of analysis is very helpful to try to figure out what the long-term prospects look like. But it's pretty scary really to see, particularly some of these brands that, Wayfair is 17, 18 years old, so it's not like it's a new company. Some of these brands are more than 10 years old. So you would expect they would be maybe more on a glide path. COVID's, on the one hand, changed a lot. You would generally think for e-commerce driven brands that would be a good thing for their business. But if you look at Warby Parker's numbers, and some of these other companies,
it helps the Pelotons of the world. Yeah. And what I sometimes think about, so we should talk about Casper getting, going private is eventually, and a lot of these investors want their liquidation moment. They want something to happen to these brands. In Canada, there was a mattress brand that was a Canadian competitor to Casper. It got bought by Sleep Country, which is the biggest mattress retailer in the country. So that's not a bad outcome in some ways for some of these brands to be kind of bought and folded in. Everybody gets their money's worth at some rate. The question in my mind, and I don't know if either of us know the answer to this, is Casper the thin edge of the wedge, the camel's nose in the tent, or is it an outlier? It got taken private for a way less valuation than it was prior. So is that a sign of things to come, or is that kind of an outlier and, other businesses are more solid and have a better future?
Direct-to-consumer brands are not new. Williams, Sonoma, Sur La Table. There's a whole host of these mail-order catalog businesses, basically LL Bean, Land's End. These were direct-to-consumer, vertically integrated, not digitally native, analog native, I guess, new acronym, that have been around forever. And guess what? They started direct-to-consumer online, but online back then was the catalog. And then, here's the crazy thing, they opened stores. When they opened stores, they discovered that their mail order catalog business got better when they opened stores. And then when things moved on online more, they discovered that stores helped their online business. So all of this was very known 20 plus years ago. So it's really not, obviously a lot has changed, but the whole concept of direct-to-consumer and the vertically integrated brand is pretty common. Certainly, many of these brands are going about it in a different way because they can pick their real estate today. They are fundamentally built on one platform, and so the omni-channel harmonized piece of it is easier for them. They don't necessarily have to break down the silos and fix things that have existed in the incumbent brands. But a lot of the model is very true. So to answer your question, I do think, there's been a lot of reports that Casper has been a little bit of a mess in terms of operating. So some of this can be chalked up to execution. But I think the broader lesson, and when we look at some of these businesses, is to ask the question, well, number one, how big is the addressable market really? Because many of these brands found that it was fairly easy to find like that perfect customer. But then, and those customers were basically finding them because they had a perfect value proposition for a certain amount of customers. Yep. These customers are using organic ways to find them. So that first 10, 20, $30 million of revenue came pretty quickly. But then you get to the point where you have to go find customers. And when you're really trying to find customers, number one, it gets really expensive. Number two, you're typically trying to steal that customer away from somebody else. So like Bonobos, in their second or third stage of growth, they're basically trying to get the Nordstrom customer, right? And Nordstrom knows who their customer is, and they're going to try to hold on to them. So it starts to become really expensive to grab that next level of customers. And or you then decide, as many have, to go the wholesale route to try to expand, which is, not exactly direct to consumer, but that's a technicality. Or, as we've seen, a lot of them are opening stores. And I think the hard thing to tell right now, except maybe you could argue for Warby Parker is most of these brands are fairly early in their store opening cycle. And most of them open, you mentioned this earlier, a lot of them open, they pay premium rents. They're in, the kind of locations that are kind of a layup. Like if you have any kind of business, you open up next to the Apple store in Soho, or you go into one, it's not hard to figure out where those first 20, 30, 40 locations are. Like they're all, go down to Austin, like you can find, there's the Yeti store, there's the Outdoor Voices store. Yeah, I mean, it's that part is not too complicated, but plenty of brands that are really niche brands, they never get beyond 40 or 50 stores. Like nobody talks about Kiehl's, if you know that brand, being 800 stores, right? I mean, people understand that it's got its niche, a very good niche. So I think it's very hard to understand. I mean, all we know is that many of them have opened these stores and overall they're still losing money. But it's pretty hard to tie together how much of that is related to their store expansion, how much of that is related to just fundamentally pricing issues or overspending on marketing. Or the business
model itself. What I thought is interesting, and to be fair, we often kid about the whole Mark Andreessen, who needs stores are gone. One thing I think that has evolved over the past 10 years that I reflect on often is 10 years ago, 15 years ago, I, as one of these brands, could really take advantage of the platforms, whether it was Facebook or Google. And if you developed some expertise, you had direct marketers, you had direct response marketers, you really, in those early days, you could really have leverage and use those to drive your business quite successfully with a ROAS is a very common measure, return on ad spend.
Yes.
Now, it's hard to find advantage for anybody of any size. And so it feels like in a world 10 years ago, I don't need a store, but now I need stores because I can't gain advantage on Facebook. So I'm going to try and gain advantage by opening a store in a high mile street or in a very prominent shopping mall. The luggage company Away just opened up in Yorkdale here in Toronto. It's a beautiful store. It's really well done. I just think that they listen. We'll do all the social media stuff that you'd expect us to, but it's hard to gain attention or leverage in the way we did even 10 years ago. Do you ever think about that as one of those kind of things that's changed in the overall macro environment that is pushing towards physicality?
Well, I think for certain types of brands, the physical store was inevitable. I think what Mark Andreessen got wrong, and the first the investment premise behind a lot of these retailers was there was an underappreciation for the value that stores add. So in the case of some of these brands, they got to a certain point, but then they did, and I happen to have access to a couple, or I've seen, I can't say who it is, but I've seen information from a couple of these brands, and pretty much they said, well, here are these interested consumers, but they want to go try it on, or they want to go understand why does this sweater $150 or whatever. So, there was a point where in order to penetrate that, they get to make the total addressable market bigger, they had to have physical stores. That was the thing that was missing. And I think if you really understood the difference between online shopping, which is basically running errands, versus something that's seeking a solution, you just knew that what Mark Andreessen said had to be nonsense. So I think there was just an underappreciation, or like this technology blindness to the value that physical stores could add. But the thing that you bring up, I think is very important as well, because it was much easier 10 years ago to build a brand online. It just wasn't that costly. I remember I had a client about 5-6 years ago where I said to them, well, the good news is you're doing pretty well. The bad news is Facebook is going to figure this out. And so I don't know enough about it to say, oh, you got 6 months or you have 2 years, but there's just no way that Facebook and Instagram and Twitter didn't have much of an advertising model back then. So it was inevitable.
There's no way. I saw the same thing. Again, I didn't know enough to predict when, but it was when, not if, that they were going to say, hey, all you guys riding for free off the bus.
Yeah, I call it. I don't know. Maybe if I stole this. Yeah, I don't know if I stole this from somebody else, but I call them like the marketing toll booth operators, right? It's like when eventually you figured out like, well, where I want to go is on this road, and you own the toll booth. Well, it's like, well, how badly do you want to go? And right. And basically you auction it off. And so I think the phenomenon, this is a little bit maybe inside baseball, and it's a little bit of Dan McCarthy's work, I think, gets at this, but just to sort of picture it is, if you can find that first batch of customers pretty easily, or they essentially find you, you've got really low cost of acquisition. The customers that love you the best tend to spend more, and they're probably not as price sensitive. So that's a beautiful customer lifetime value segment, right? Or cohort. Then as you start to try to build the base more, you start to have to pay to find them and target them. And now you're competing with whoever is also competing with them. So your marketing costs start to go up. When you think about those additional cohorts you start to add, they're not the most perfect fit for your business model. So their total lifetime spending is likely to be lower, and they probably are more price sensitive. So the worst case scenario you have is your cost of acquisition keeps going up, and the marginal value of the customers you're bringing in is going down. And essentially what I think has happened at Casper, has happened at Wayfair, has happened at some of these other companies, is they're now realizing that, yes, the more we're spending more to bring them in, but the incremental value of the customers we're bringing in is not economic. So that has to be reset. The store investment conceivably does a few things. One, it increases the total addressable market. It may bring down your acquisition cost. You're paying, rent is sort of the new customer acquisition cost. I know it's become a cliche, but that's true. And in some categories, probably not away, but certainly in a lot of apparel categories, as we know, the return rates are really high online. So another big driver of opening stores is to try to get the return rates down. I've talked and written about kind of how this had to evolve. So I don't think any of this is tremendously unexpected. In fact, the other day I posted on LinkedIn, you may have seen it, that I think COVID kind of pushed this reckoning down the road by about 18 months because so much shifted online and the cost of acquisition came down. But now as it's starting to go back, cost of digital marketing is sky high again. It's a different environment going forward. So I think it's going to take us a little while to really sort out. I don't think Casper is necessarily the canary in the coal mine, but I think it speaks to some issues. And the more quarters we get from some of these brands that haven't been public too long, the more that file for IPOs, we'll just get a closer look, and it'll become a lot more clear what to look for. But we're in this kind of little bubble where the recent results are decent because of the move to e-commerce, and I think there's a lot of investors that just kind of have faith that will all work itself out. The last thing I was going to say, though, I would encourage people, if they care about this, to take a look at some of the established brands and what their numbers look like. Because I've been saying, I just can't get my head around these $5, $6, $7 billion valuations for some of these brands, given the size of the business and the trajectory of their losses. You can go out and look at a great former client, direct-to-consumer brand called Duluth Trading Company. Duluth Trading Company's been around for a while. They have, I think, 65 or 70 stores, vertically integrated brand. And, I think their operating EBITDA margins are something like 12, 13%. So here's a business that's, $600-700 million, which is way bigger than Allbirds. Yeah. Considerably bigger than Warby Parker, and has 60, 70 stores like Untuckit, Bonobos, and others do, and some of them are moving to that number. And, they're cranking out pretty good money. Now, I don't think anybody thinks they're a hyper growth story at this point. So, they're not apples to apples, but I think you can look at American Eagle. You can look at some other companies that are essentially vertically integrated direct-to-consumer brands and have a frame of reference and ask yourself, well, if Duluth Trading Company is valued much less than Allbirds, is Duluth Trading Company undervalued?
Yeah.
Or is there just a because there's something about,
alignment in the universe, right?
Right. I mean, it just, obviously Allbirds and these other companies, Rent-the-Runway, whatever, pick your favorite one. They're all, early in their maturity curve, but, you have to be able to work your way to being a fairly sizable business with decent EBITDA margins, in the not too distant future, or the discounted cash flow, not to get into financial theory here, but like it doesn't, something's one of those numbers has got to be wrong. But it's,
That's well put.
But it's typical with, these, and you've said it many times, these stocks are valued on the story, and, the way the stock market works, the venture capitalists want to IPO it, and, there's some people that just will buy any super sexy stock. And so it's the greater fool theory, I guess, is what you call it. Or they're hoping, Unilever bought, they buy Dollar Shave Club at what now looks like to be a crazy price. Walmart bought Jet at a really crazy price, and Bonobos and some others. So, you don't want to be the one left holding the bag. I think or when the music stops or whatever.
It is a game of musical chairs, and it's funny. I got to put my hand up. I bought Rivian stock last week. There's a stock that came out IPO more valuable than Ford, and they haven't made a truck yet, basically, in the market. So, but I bought the stock, and you know what? It's actually doing okay. It's a beautiful truck, by the way. Talk about a great story. And I wanted to end this episode on a positive note, because I think out of all this, out of these brands, some may get taken out, some may not survive. Ones like Warby Parker may consolidate. They may have the strength to bring in several. Like, there's a lot of paths to success for many of these brands. And what I love about it, listen, I love talking about them. I think they're doing interesting things. Sometimes the business model looks a bit shaky. Sometimes I don't get it. And sometimes I'm wrong. And somebody sees a lot of great things in them, and sometimes they don't succeed. But it is, I wish them all the best. I find it fascinating, one way, shape, or another, and I think there's hope for some of these brands in one way, shape, or another. So I like to remain optimistic about some of these brands.
Absolutely, yeah. Some will absolutely turn out to be great brands. I mean, the only thing that really I find a little bit sad is when the venture capitalists or the investor world supports these brands to kind of a crazy degree, and it puts unfair pressure on retailers big and small to compete, because basically the venture capitalists are subsidizing this crazy amount of marketing, and in many cases these unsustainable prices.
It unlevels the playing field, basically, because these brands pay outsized amounts for the technology they're buying, for the people that they're hiring, for the stores that they're leasing, for the on and on and on. So I think there is a distortion element to it that is net negative, I think, to the industry in some way, shape, or form.
But I do think the flip side of that is that these disruptor brands, they make, hopefully, some of the legacy brands stronger, because they show new and different ways to do business, whether that's more asset light model, more showroom model or whatever. Most of them to me are great depictions of what I call harmonized retail, right? They build it as one brand in many channels, not omni-channel, multi-channel that you have to integrate and deal with all these silos. Most of them are very customer data driven. So I think there's a ton to be learned from retailers big and small, but say more traditional type of retailers, by looking at what these companies do to be customer centric, to really zoom in on that customer journey, to think about go-to-market strategies in a really different way. And, that brings great value to the consumer for sure. And in many cases, I think that just sharpens the saw for other retailers. So I'm all in favor of more innovation. But I do think at some point, you're not really prosperous if you don't make any money.
Great way to wrap. Listen, this has been a great discussion. And I think we'll come back to this as things evolve over the years, but really nailed it, I think, in terms of this, trying to understand their role in this big retail ecosystem that you and I love. If you like what you heard, please follow us on Apple, Spotify, or your favorite podcast platform so you can catch up with all our great episodes, including our recent interview with Carrie Baker, President, Canada Goose. And be sure to drop us that 5-star review where you listen to your podcast. It really helps us spread the word.
And I'm Steve Dennis, strategy and innovation consultant, keynote speaker, and author of the best-selling book, Remarkable Retail: How to Win and Keep Customers in the Age of Disruption. You can learn more about me at stephenpdennis.com, and be sure to follow me on LinkedIn, Twitter, and Instagram.
And I'm Michael LeBlanc, consumer retail growth consultant, keynote speaker, and producer and host of a series of retail trade podcasts, including this one. You can learn more about me on LinkedIn Safe travels, everyone.